If you had started investing just $5 a day at age 20 instead of 30, you wouldn't just have more money by retirement. You'd have almost double. Not because you worked harder. Not because you got lucky. Just because of 10 extra years. That's the entire lesson of this video, and once you understand why it's true, you'll never look at money the same way again. There's a force in personal finance more powerful than any stock tip, any side hustle, any secret the rich supposedly keep from everyone else. It's called compound interest. And it's just math. Boring, repetitive, unglamorous math. But given enough time, it turns ordinary savings into serious wealth, all on its own. Here's how it actually works. When your money earns interest, you don't just earn on what you originally put in. You earn on what you earned. And then you earn on that too. It stacks, layer after layer, year after year. Say you put $1,000 into an account earning 10% a year. After year 1, you have $1,100. In year 2, you're not earning 10% on your original $1,000. You're earning it on $1,100, so you gain $110 this time, not $100. Small difference. But keep going. By year 10, that $1,000 has grown to about $2,600. By year 20, almost $6,700. By year 30, close to $17,500. From $1,000 you never touched again. Here's the part almost nobody tells you. In the early years, compounding looks like it's barely working. The first few years feel identical to just earning simple interest. That's exactly why most people quit too soon. They mistake the slow start for failure. But the gap between compound growth and simple growth doesn't increase in a straight line. It explodes exponentially. Slow, 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 then suddenly fast. If you quit in year 3 because nothing's happening, you're walking away right before the part where it gets powerful. Einstein is often quoted as calling compound interest the 8th wonder of the world, saying whoever understands it earns it, and whoever doesn't, pays it. That second half matters just as much. Compound interest doesn't pick a side. It multiplies whatever you feed it. Owe money on a credit card at 20% interest, and only pay the minimum? That debt compounds against you with the exact same mechanics that would have made you rich if you were investing instead. Now here's the comparison that changes how people think about this forever. Person A starts investing at $200 a month for 10 years. Then stops completely. Never adds another dollar. Just lets it sit until age 65. Person B waits. Doesn't start until 35. But once they start, they don't stop. $200 a month for 30 years straight, 3 times as long as Person A. At an average 8% annual return, Person A ends up with roughly $580,000, having put in $24,000 total. Person B, who contributed $72,000, 3 times as much money, ends up with about $490,000. Less. The only difference between them is 10 years. Person A's 10-year head start was worth more than an extra $48,000 in contributions from Person B. You can always add more money later. You can never add more time. That's why every financial advisor pushes young people to start early, even with small amounts. The clock matters more than the size of the first deposit. So what actually drives this? 4 things. Principal, the amount you put in, matters less than people assume. Rate of return matters more than most people realize. The gap between 6% and 9% a year, compounded over 30 years, can nearly double your final number, which is exactly why high fees quietly destroy wealth. A 1 or 2% fee isn't small. It's 1 or 2% that stops compounding for you and starts compounding for someone else. Time is the real multiplier. Everything else works better with more of it. And consistency, showing up every single month regardless of whether the market feels good or bad, is what turns this from a math trick into an actual life-changing habit. You're not trying to time the perfect moment. You're just not stopping. You see this playing out everywhere in real life. Retirement accounts are built entirely around decades of uninterrupted compounding, with tax advantages that let more of the growth stay invested instead of leaking out every year. Index funds don't promise excitement, just a steady 7 to 10% average return over time, which sounds boring until you watch what it does across 20 or 30 years. Someone who simply bought a broad market index fund and never touched it has, historically, outperformed most people who actively tried to pick winning stocks, purely because they let the compounding run undisturbed. Real estate compounds through both mortgage paydown and appreciation happening at the same time. Every payment you make builds a little more equity, and if the property's value rises over the years, that growth stacks on top of an already growing base. And debt, remember, compounds against you exactly as hard. Paying off a 20% credit card is functionally a guaranteed 20% return, better than almost anything else available to you. This is why paying down high-interest debt should almost always come before putting extra money into investments. There's no stock market return that reliably beats the interest rate you're bleeding on unpaid credit card balances. One honest warning, this isn't instant, and it's not a straight line. Markets fall. Some years will look bad, sometimes badly bad. The people who actually benefit from compounding are the ones who stay invested through the rough years instead of selling in a panic, because selling during a downturn doesn't just lock in a loss, it kills the compounding process at the exact moment the recovery is about to start. Every major downturn in history has eventually been followed by recovery and new highs, but only for the people who stayed in the game long enough to see it. So here's what to actually do with this. If you're young, start now, even small. $50 or $100 a month in your 20s can outgrow a much larger amount started later, purely because of time. If you're starting later, don't spiral about the years you missed. Focus on consistency and return from this point forward, and get rid of any debt that's compounding against you first. Compound interest isn't a secret. It's not a hack reserved for the wealthy. It works identically whether you have $10 or 10 million. It just needs time, consistency, and a starting point. The best time to start was years ago. The second best time is today.